Welcome to the Deep Dive. You're here because, like us, you want to get a handle on what's happening with NFT lending. It can seem pretty complex, right?
Yeah, definitely. Lots of moving parts.
Exactly. So today we're diving in. Our mission is to figure out why this market's seen such a downturn and, crucially, what might bring it back. We're drawing on a recent report from DappRadar.
That's right. It's a really insightful piece, and it gives us a lot to chew on regarding the current state and maybe the future state of NFT lending.
Okay, let's get straight into it then. The numbers are pretty stark. DappRadar points to this huge drop in lending volume. We're talking, around $1 billion peak in January last year?
Yeah, about that.
And now, just $50 million this past May. I mean, that's a 97% decrease. It's
massive.
It really is. And just to remind everyone, NFT lending is, basically using your NFT as collateral for a loan.
So why the huge drop? What's behind that 97% figure?
Well, it's not just the total money involved. The number of people participating has also fallen off a cliff. Borrowers are down like 90% since that peak. 90%. Wow.
Yeah, and lenders are down too, about 78% over the same period. So it's hitting both sides. Fewer people wanting to borrow, fewer willing to lend.
That suggests a real lack of engagement or maybe just confidence across the board.
Precisely. And look at the loan sizes themselves.
Right. I saw that the average loan used to be around, $22,000 back in 2022?
Mm-hmm. Now it's down to $4,000 as of May. That's a 71% drop year over year.
So what does that tell us? Are the NFTs being used just, lower value ones? Or are people getting more cautious?
It's likely a bit of both. Sarah Gergelis, the analyst at DappRadar, suggests exactly that. Either the underlying assets, the NFTs, are simply worth less now.
Which many are, let's be honest.
Right. Or borrowers are just becoming much more conservative.
Yeah.
Taking out less leverage against whatever assets they do have. Probably a mix of those two factors.
And interestingly, the loans aren't just smaller, they're also shorter. The average duration has dipped.
Yes, slightly. It was around 40 days on average back in 2023.
And now it's holding steady at about 31 days through last year and into this year.
So roughly a week less. Gergelis floats the idea that maybe this points towards more frequent, shorter-term borrowing.
Like not for long holds, but for quick liquidity. Tactical plays, maybe.
Possibly.
Yeah.
Instead of betting on long-term appreciation, maybe people are using it just to bridge cash flow gaps for shorter periods. It's an interesting shift in behavior if that's the case.
It definitely suggests a different kind of user need, perhaps.
Yeah. And you have to ask what pressure that puts on the lending platforms themselves if they were built for longer cycles.
Good point. So, okay, this lending downturn, it's not happening in isolation, is it?
Not at all. It's pretty closely tied to the general cooling off in the broader NFT market.
Makes sense. What are the numbers there?
The report mentions overall NFT market volume dropped 61% in the first quarter of this year compared to the year before. We're talking $1.5 billion, down from $4.1 billion.
As the whole ecosystem is feeling it.
Exactly. And Gergelis puts it quite plainly. With collateral value collapsing, the lending activity naturally followed. It's a direct link.
The value of the stuff being lent against just isn't there like it was.
Pretty much. When the asset value drops, lending against it becomes way riskier and, frankly, less attractive for everyone involved.
Now, the report does acknowledge a few exceptions, right? Some NFT collections that have held up or even gained.
Yes, there are always outliers.
Yeah.
But the key point is that these haven't been nearly enough to lift the entire lending sector.
Like a few bright spots don't change the overall weather.
Nicely put, yeah. It underscores the systemic nature of the downturn in lending.
So where does that leave us? The report talks about needing new catalysts. What does that mean?
It means the market needs something fresh, some new reason for people to engage, to move beyond what Gergelis calls survival mode.
Survival mode. Oof, that sounds grim.
It reflects the current pressure, yeah. Without some new energy or innovation, the trend might just continue downwards.
Okay, so what are these potential catalysts? The big one mentioned seems to be RWA's real-world assets.
Ah, yes. This is where it gets really interesting, potentially transformative, linking real-world assets with NFTs.
Explain that a bit more, like tokenizing a house.
Exactly. Or tokenizing ownership in, say, yield-bearing financial assets. You take a tangible off-chain asset and you represent its ownership digitally on the blockchain as an NFT.
And the benefit for lending is?
Stability and trust. If you can use tokenized real estate or something similarly stable as collateral, it suddenly looks a lot more appealing to lenders who might be spooked by the volatility of purely digital collectibles.
Right, it brings in collateral that people understand that has a more established, maybe less speculative value.
Precisely. It could fundamentally change the risk profile and potentially unlock a lot more capital for the lending market.
Okay, RWAs sound like a big deal. What else? The report mentioned other things too.
Yeah, simpler stuff too, like just making it easier for people to use the platforms. Better user experience is always key, right? Reducing friction for borrowers.
Always. And then there was this idea of smart infrastructure. Sounds sophisticated.
It is. It refers to building more advanced financial tools into these lending protocols. Things like under-collateralized loans.
Loans where you don't have to put up the full value, like in traditional finance.
Sort of, yeah. Which is obviously riskier in crypto, so it needs careful handling. Also, developing credit scores specific to the crypto space.
A way to judge borrower risk beyond just collateral.
Exactly. And using AI, artificial intelligence, to better match borrowers and lenders and assess risk more accurately. These are tools that could make the market more efficient and maybe attract more sophisticated users or institutions.
It sounds like the whole space is trying to grow up a bit, financially speaking.
That's a good way to put it. It's evolving. We're also seeing consolidation. The report notes only about 8 lending apps really have any meaningful market share now.
So a shakeout is happening. The weaker platforms are falling away.
Seems like it. And Gergelis makes an interesting point that the old model, the sort of flip for liquidity frenzy we saw in the bull market.
Yeah, buy low, sell high, quick profits.
Right. That model just doesn't fit the current mood, which is much more risk averse. You can't build a sustainable lending market purely on short-term flips.
So the game has changed?
The game has definitely changed. But, and this is important, the report doesn't say NFT lending is dead.
Okay.
It suggests it's shifting focus. The platforms that are surviving are diversifying, looking at different use cases, maybe accepting different kinds of collateral. It's an adaptation process.
Adapting to the new reality. Less hype, maybe more substance.
That seems to be the hope. Gergelis ends on a cautiously optimistic note. If the next phase is built more on real utility.
Like those RWAs or other practical uses.
Exactly. Utility plus culture and community, which are still huge in NFTs, and just better design, then NFT lending can find a second wind.
A more sustainable one, hopefully.
One that's potentially built to last this time.
Okay, so let's quickly recap our deep dive. NFT lending took a massive hit. Volumes down, users down, closely tied to the broader NFT market cooling off.
Yep, the collateral value drop was key.
But it's not necessarily over. The path forward seems to involve integrating real-world assets, building smarter, more sophisticated financial tools.
And generally shifting away from pure speculation towards more sustainable utility. It's a market in transition.
Definitely a space undergoing significant change, trying to find its footing for the long term.
It really shows how fast things move in digital assets. What worked yesterday might not work tomorrow. Constant evolution.
Absolutely. And that brings us to a final thought for you, our listeners. Thinking about this potential of tokenizing real-world assets for lending. What other kinds of traditionally illiquid assets, things that are hard to buy and sell quickly, do you think could be revolutionized by this RWA approach? And maybe more importantly, what are the big hurdles, the challenges, and actually bringing those assets securely and reliably onto the blockchain so people trust them?
That's a great question. Lots to think about there.
Definitely something to ponder. Thanks for joining us for this deep dive.